The yield curve, that is the difference in yields between 2- and 10-year notes, is holding near the steepest on record. At the same time, you've got the U.S. government getting ready to sell yet another $100 billion of notes. So joining us now with his thoughts on the bond market is Michael Pond. He's an interest rate strategist at Barclays. The firm is the largest trader of U.S. inflation-linked debt and also a primary dealer. Thank you so much for coming in on this Christmas Eve morning. Let's start with Treasury announcing that it'll be selling $118 billion of 2-, 5-, and 7-year notes next week. These are record-matching amounts of debt out there. What kind of investor appetite do you see for this debt?
Well, it seems like every 2 weeks we get record Treasury auctions, and that's likely to continue over the next couple of quarters as the Treasury just has an enormous amount of borrowing needs over the coming quarters. Fiscal spending continues. We do see strong demand for Treasuries, but it's not...
For these durations?
For these durations, foreign central banks have been active players really out to the 7-year, but after Chinese officials made comments around potentially not buying as many treasuries as they have been, that spooked the market and really kicked off a pretty significant sell-off led by the 10-year sector, and then mortgage convexity selling piled onto that, and we've seen a pretty strong sell-off over the past week or so in the Treasury market. Now that actually sets up for pretty good auctions now that treasuries have cheapened so much.
Right, so they could potentially get a good deal.
That's right.
What about the timing? You've got a holiday shortened week. How's that going to affect demand?
You know, that's something that the Treasury Department has been concerned about for quite a while. The 7-year in particular coming just the day before New Year's Eve, when the Fed had been a very strong buyer of the 7-year sector in particular to help out mortgage rates. That auction is probably the one to worry about. The 2-year should be well spoken for. There's plenty of demand, particularly into year-end, for very short paper. It's really further out the curve that we have concerns about.
Okay, so watch the 7-year as a litmus test.
That's right.
The yield curve, we were talking about that. It's at about 285 basis points, beyond expectations of an economic recovery. What else does this record spread reflect?
Well, again, it is at a record. There's potential for it to go further still, though, in part because short rates are at a record low. The Fed funds rate is near zero.
Not going up anytime soon.
And likely to remain so for the next several quarters at least. And even once the Fed starts to remove stimulus, we think they'll do so at a very gradual pace. And that could steepen out the yield curve further if economic data continues to come in on the positive side as we expect. Investors are becoming a bit more concerned about the medium-term outlook on inflation, and that means that with short rates at historical lows, the yield curve can continue to steepen beyond historical highs.
And when you talk about the market becoming more concerned about inflation, trading in tips certainly suggesting that inflation is winning out over the prospect of deflation. Have we seen the end of that debate over falling or rising prices?
Well, there's still concern about sharp disinflation over the near term. The talk of deflation has, for the most part, been taken off the table, although still a concern if oil prices were to decline significantly from here. We don't expect that.
Which could happen, though, if the dollar continues to rally.
It certainly could happen, but what we've seen is a decoupling between oil and the dollar over the past couple weeks, where the dollar has been rising mostly against the euro rather than a broader basket of currencies, and that part of that story is because of concerns over downgrades of Greece and other concerns particular to Europe. So there has been a decoupling there. So we don't necessarily think that oil needs to fall if the dollar continues to rally.
Right. External shocks certainly something that investors will be on the watch
right.
for next year. Now, in late November, you were on Bloomberg and you said that yields did not reflect reality then. With the 10-year yield now at a 4-month high or roundabout, and the 2-year at a 7-week high, does that reflect reality more now?
It's more so.
But not quite yet.
We think yields will continue to head higher over the next year. In the near term, we think that rates have backed up enough that we don't expect a continuation of the past week, but we do think the 10-year will end next year at around 4.5%. The Fed has depressed rates by its quantitative easing program. As they come to an end of buying agencies and mortgage-backed securities at the end of Q1, we think that eventually rates will head higher.
All right, we thank you for your thoughts. That's all we have time for, but we'll have you back on pretty soon to talk about the auctions next year. We've been speaking with Michael Pond. He's the interest rate strategist at Barclays here in New York.